Wait, before you buy Microsoft after earnings, you need to understand something most investors completely miss. Microsoft can beat revenue, it can beat earnings. Azure can continue growing at nearly 40%, and the stock can still get crushed. But here's the dangerous part. Microsoft dropping after earnings can look exactly like a buying opportunity, even when the underlying business is beginning to weaken. That is exactly how untrained money gets trapped. They'll see Microsoft down 5%, 7%, or maybe even 10%, and they'll immediately start screaming, buy the dip. But they never stop to ask, why is the stock failing? Because a lower price does not automatically mean you are receiving more value. Sometimes the market is just overreacting. Other times the market is warning you before the problems become obvious. So in this video, I'll be giving you the 3 numbers I'll be watching when Microsoft reports earnings Wednesday after the market closes. These 3 numbers will help us figure out whether a Microsoft sell-off creates a valid leaps opportunity or whether buying the dip could put you inside of an earnings trap. And the 3rd number is the one I believe most retail investors are going to overlook. The stock market is where money flows into businesses. People who understand that flow build wealth. My name is Flo. Go ahead and subscribe if you want to understand the market. When most people watch an earnings report, they only look at 2 numbers, revenue and earnings per share. Did the company beat revenue and did it beat earnings? And if the answers to both of those are yes, they assume the stock should go up. But that is not how the market works. The stock market does not simply reward companies for just beating the past. The market prices businesses based on what investors believe will happen next. That means Microsoft could report an incredible quarter, but if Wall Street believes growth is slowing, spending is getting out of control, or profitability is weakening, the stock can still get punished. So instead of treating earnings like a report card, I'm asking 3 questions. Is demand still growing? How much money Microsoft is spending to meet that demand? And is that spending producing profitable growth? Those 3 questions lead us directly to the 3 numbers. For the last quarter, Azure's growth was 40%. Microsoft expects that same exact growth for this quarter. That makes Azure the first real test. Microsoft has several major businesses: Windows, Microsoft 365, LinkedIn, gaming, and even Bing Search. But Azure is at the center of the Microsoft investment story right now because Azure is where much of the demand for cloud computing and artificial intelligence infrastructure shows up. So I'm not simply asking whether Azure grew. Of course it's going to grow. The real question is whether or not Azure can maintain or even exceed the growth rate management already promised investors during the last earnings call. As I've said before, that growth rate is about 40%. Here's how I'm reading that number. If Azure grows at 40% or better and management maintains strong forward guidance, that tells me that demand remains strong. It would even be more impressive because Microsoft has repeatedly said customer demand is greater than their capacity to keep up with it. In other words, the problem is not the lack of customers. The problem will be Microsoft trying to bring enough infrastructure online to serve those customers. But that's a good problem to have. But if Azure falls below the expected 40% range, our management guide says that the growth is slowing down next quarter, then we have to pay attention. Because that could mean one of 2 things. Either Microsoft still cannot bring capacity online quick enough, or demand may not be growing as aggressively as investors have expected. And Wall Street is not going to treat those 2 explanations the same. So don't get tricked by the headline either. If Azure comes in at about 39%, people may say growth slowed down from 40%. But management guided for 39 to 40%, so Microsoft will still be safe. What matters is the result compared with guidance, and even more importantly, what management says about the next quarter. So number 1 tells us whether demand is holding. But demand alone does not make an investment profitable because Microsoft is spending an unbelievable amount of money trying to satisfy that demand, which brings us to number 2. The second number is more than 40 billion. That is how much Microsoft expects to spend on capital expenditures during the quarter. Last quarter, Microsoft spent almost 32 billion. Management now expects quarterly capex to increase above 40 billion. That's about $8 billion in additional spending. And for 2026, Microsoft expects to invest roughly 190 billion in capital expenditures in total. Now let that sink in. Microsoft is preparing to spend 190 billion dollars in one calendar year. That is not a normal investment cycle. That is Microsoft making one of the largest infrastructure bets in corporate history. And this is where investors are going to split into 2 groups. One group will say that Microsoft is building the infrastructure that will power the next era of technology. The other group will say Microsoft is spending way too much money before it's proven that AI can generate enough profit to justify the investment. Both sides have a legitimate argument. That is why the CapEx number cannot be judged by itself. Last quarter, Microsoft said roughly 2/3 of its CapEx went towards shorter-lived assets like GPUs and CPUs. Think hardware. Those are the computer resources that help Microsoft increase Azure capacity, train models, run inference, and power products like Copilot. The remaining portion went towards longer lived assets such as data center infrastructure that Microsoft expects to monetize over many years. Now, management also said that about 25 billion of its planned calendar year capex comes from higher component prices. That distinction matters. If spending rises because Microsoft is installing more revenue producing capacity, that could support future growth. But if GPUs, CPUs, and storage keeps getting more expensive, Microsoft could spend much more without adding the same amount of capacity. So I need management to answer three questions. How fast is the new capacity coming online? How much customer demand is waiting for it? And how quickly will that capacity turn into revenue, meaning actual cash for the business? If Azure remains strong, if Microsoft says the demand exceeds supply, and the new infrastructure begins generating revenue quickly, Wall Street may eventually reward the CapEx spending. But if CapEx climbs above 40 billion, while Azure slows and management becomes less confident about future demand, that is a whole different situation. That would mean spending is accelerating while the business connected to that spending is decelerating. In other words, the pace of cost would be going up while the pace of growth would be going down. That is exactly how an opportunity turns into a trap. But we still need one number because strong growth and high spending do not tell us whether Microsoft is creating profitable growth. That is why number 3 may be the most important number in the entire report. The third number is 64%. Last quarter, Microsoft Cloud produced a gross margin of almost 66%. For this quarter, management expected Microsoft Cloud gross margin to be about 64%. See, let me break it down. Azure growth tells us how quickly demand is increasing. CapEx tells us how aggressively Microsoft is spending, but cloud gross margin begins telling us what the economics of that growth actually looks like. Microsoft has warned investors that higher AI infrastructure costs and increased use of products like GitHub Copilot will raise expenses and reduce how much profit it keeps from cloud revenue. In other words, AI products like Copilot are very expensive to run, so Microsoft may keep less profit from every dollar of cloud revenue. So a decline from 66% to roughly 64% is not automatically a failure. In fact, Microsoft has already told investors to expect it. The real question is whether Microsoft performs better or worse than that expectation. If gross margin comes in around 64% or better, while Azure comes in at least 40% growth, that tells us that Microsoft is managing the cost of expansion pretty well. It will mean the company is spending aggressively, but it is still protecting the underlying economics of the cloud business. But if cloud gross margin falls well below 64% and Azure slows and management warns that margin pressure will continue getting worse, that is a huge red flag because now you have slower growth, higher spending, and weaker profitability happening at the same time. Personally, that's not a dip that I would want to buy, but that is a business trend that I would need to investigate. But the good news is that Microsoft has already provided some evidence that AI is beginning to monetize. See, last quarter, the company said that its AI business surpassed 37 billion in annual revenue, growing at least 123% year over year. The company has also said that it had more than 20 million paid Microsoft 365 Copilot seats. This is very strong evidence that the money is starting to come in, but now investors need to see whether AI revenue and product adoption are growing quickly enough to offset the infrastructure costs required to deliver them. A company can have an incredible revenue growth, but still disappoint investors if the cost of producing that growth rises way too quickly. This is why the third number matters. It measures whether Microsoft is simply getting bigger or whether Microsoft is getting bigger efficiently. See, those are two different things. Now let's put these three numbers together. Scenario 1 is the overreaction. Let's say that Azure comes in or above the 39 to 40% range. Let's also say that CapEx rises above 40 billion, but management connects that spending to clear customer demand and additional revenue producing capacity. Let's also say that cloud gross margin lands at about 64% or even performs better than expected, and that forward guidance stayed strong. But the stock still drops because Wall Street becomes nervous about how much Microsoft is spending. That is a scenario where I begin looking for a leap's opportunity, not because the stock is down, but because the price is falling while the underlying business continues improving. That is what we like to call a potential market overreaction. We want to exploit these opportunities. Scenario number 2 is the mixed report. Let's say Azure lands inside the guided range, CapEx rises as expected, and gross margin lands around 64%. But management gives cautious or unclear guidance about the next quarter. Well, that's not automatically bullish or bearish. That's just a situation where trade money is going to wait. You don't have to make a decision 5 minutes after earnings. You could just listen to the call, read the transcript, review guidance, and just let analysts ask management questions, and then decide whether the risk and potential return makes sense. Sometimes the best trade after earnings is no trade at all. Scenario 3 is the trap. Let's say Azure misses the guided range or that management forecast hits at the growth slowing down. Let's say that CapEx rises above 40 billion, and cloud gross margin falls below expectations, and management gives weaker forward guidance. That combination would tell us that demand is slowing, spending is rising, and profitability is weakening. A 5% or a 10% stock decline would not automatically make that an opportunity. See, the company could still be a great long term business, but a great company can still be at a bad entry at the wrong price and during the wrong business trend. Company quality and entry quality are simply not the same thing. That is the lesson Untrained Money keeps learning the hard way. Before I consider taking the Microsoft leaps position, I'm going to consider four things. First, the fundamentals must pass the three-number test. Azure growth needs to remain strong. Management needs to prove that the higher capex is supported by real customer demand and a believable path to revenue. And cloud margins need to show that Microsoft can handle spending without damaging the profitability of the underlying business. Second, I need a real market overreaction. A 2% drop is not automatically enough to give me a strong margin of safety for a leaps position. I need some cushion. I would personally be interested at a 10% drop or more. I want to see a clear gap between the falling stock price and the improving fundamentals of the business. Third, I need the initial earnings volatility to settle. See, options often become expensive before earnings because traders expect a very large move, especially for companies like Microsoft. But after earnings, implied volatility can actually collapse. That means you can correctly predict the stock's direction and still lose money because you pay way too much for the option. And fourth, I need the chart to show that buyers are starting to defend the stock. I'm not buying simply because I see a red candle. I want to identify support and let the stock build a clear structure and then decide whether the risk to reward makes sense. That is trained money. See, untrained money tries to predict the earnings candle. Trained money waits for the report, studies the business, watches the market reaction, and then and only then takes the trade when the opportunity becomes clear. So when Microsoft reports earnings, ignore the noise and remember these three numbers. 39 to 40% tells us whether Azure demand remains strong. More than 40 billion tells us how aggressively Microsoft is spending to meet that demand. And about 64% tells us whether Microsoft can convert that growth and spending into a sustainable cloud economics. Strong demand, high spending, and stable profitability could create an opportunity if and only if the stock sells off. But slowing demand, higher spending, and weakening profitability could create a trap. The question is not simply whether Microsoft beat earnings. The question is whether Microsoft's business is becoming stronger or weaker underneath the stock price. Because price going down does not automatically create an opportunity. But price going down while the underlying business keeps improving, that's exactly what trained money looks for. For the live post earnings breakdown and my complete leaps decision process, be on the lookout for that video. I normally drop that on Fridays. I will walk through Microsoft's actual numbers, the earnings call, the stock reaction, and whether the setup meets the trained money framework. Comment Microsoft below and tell me which of the three numbers you believe matters most. Subscribe, turn on your notifications, and send this video to somebody who is preparing to blindly buy the Microsoft dip. As always, peace.